The most dangerous moment in any market rally is not when prices start falling. It is the exact moment when everything looks perfect. When the chart is screaming higher, when volume is exploding, when every headline confirms what you already believe, when it feels absolutely certain that this time, finally, you are on the right side of the trade. That moment has a name on Wall Street. They call it a buying climax, and it is precisely when the biggest players in the market are quietly handing you their shares while you celebrate your brilliance. Let me show you how this works, because once you see it, you will never look at a market rally the same way again. Picture a stock that has been climbing steadily for weeks. Good earnings, positive analyst upgrades, social media buzzing with excitement. Each day brings new highs. Each dip gets bought immediately. The trend feels unstoppable. Then comes the day, the breakout day. Volume explodes to 3 times normal levels. The price gaps up at the open and keeps running. Trading forums erupt with rocket emojis. Financial news anchors speak with barely contained excitement. This is it, the moment everyone has been waiting for. And right there in that euphoric surge, something invisible happens. The institutions who have been holding this stock for months or years recognize the moment for what it is. They see the flood of retail orders pouring in. They see the emotional buying, the fear of missing out reaching fever pitch, and they begin to sell. Not in obvious ways, not with giant red candles that would spook the crowd. They sell into the strength, methodically, patiently, using the massive retail demand as their exit liquidity. Every share they sell finds an eager buyer who cannot believe their luck getting in on such a strong move. This is the buying climax. Maximum public participation, maximum enthusiasm, maximum volume, and maximum distribution by smart money. Here is the cruel mathematics that makes this work. Institutions cannot exit large positions quickly without destroying the price. If a hedge fund holds 5 million shares and dumps them all at once, they crash through every bid on the order book. They would be selling into their own selling, getting worse and worse prices with each transaction. But during a buying climax, something magical happens for them. Retail traders provide an ocean of buy orders. The institution can feed shares into this demand gradually, getting excellent prices while the crowd absorbs their entire position. From the outside, the chart looks incredibly bullish. Volume confirms the move, price makes new highs. Every traditional signal says buy. From the inside, wealth is transferring from late buyers to early holders at the exact moment when optimism peaks. The pattern repeats across markets with mechanical precision. In 2021, certain meme stocks experienced textbook buying climaxes. Prices spiked on astronomical volume. Social media declared victory. New investors rushed in believing they were joining a revolution. Meanwhile, data later showed that institutional holders and early insiders were selling into the frenzy. The same dynamic appeared in crypto during the 2021 peak. Maximum excitement, maximum new wallet creation, maximum influencer promotion, and maximum distribution by large holders who had been accumulating for years. It happened in the dot-com bubble, it happened in the housing market, it happens in individual stocks every single week. The pattern is fractal. It occurs on every time frame from 5-minute charts to monthly charts. What makes the buying climax so effective as a trap is that it weaponizes your own pattern recognition against you. You have been taught that volume confirms moves. High volume on an up day means buyers are in control. The breakout is real. The trend is strong. And this is true most of the time, until it becomes the exact mechanism used to exit positions at your expense. The volume is real. The buying is real. What you cannot see is who is on the other side of those transactions. You see confirmation of strength. They see confirmation that enough liquidity exists to complete their exit. There is a specific signature that often accompanies these events, though it requires careful observation to detect. During a genuine continuation move, volume tends to be elevated but sustainable. The price advance is steady, pullbacks are shallow and orderly. During a buying climax, the volume often spikes to extreme levels relative to recent history. The price movement becomes vertical or parabolic. The advance accelerates rather than maintaining pace. There is a feeling of urgency and inevitability. And then comes the tell. that reveals the trap. After the climax day or days, the price fails to follow through. It might hold up for a while, even make marginal new highs, but the character changes. Volume on up days begins to shrink. Volume on down days begins to expand. The easy gains stop coming. The buyers who rushed in at the top find themselves underwater with no new buyers arriving to bail them out. This is the aftermath of distribution. The smart money has completed their exit. The stock is now held primarily by those who bought the excitement rather than the value. Professional traders who study market structure look for these setups not to buy them, but to recognize when others are being set up. They understand that maximum bullish sentiment often marks minimum forward returns. Richard Wyckoff documented these patterns over a century ago. He identified the buying climax as a critical phase in what he called the distribution schematic. The concepts have not changed because human psychology has not changed. Greed still feels the same. Fear of missing out still drives the same behavior, and institutions still need retail liquidity to exit their positions. What makes this particularly uncomfortable to accept is that it means the market is not always a fair game between equal participants. When a hedge fund with sophisticated order flow analysis and direct market access decides to distribute a position, they have tools and information that retail traders do not possess. They can see the depth of the order book. They can monitor options flow and dark pool activity. They can execute with algorithms designed to minimize market impact. The retail trader sees a green candle and high volume. The institution sees exit liquidity. This asymmetry does not mean the market is rigged in some conspiratorial sense. It means that information and execution advantages are real, and they tend to benefit those who have studied market microstructure over those who have only learned to read basic charts. So what do you actually do with this knowledge? First, become deeply suspicious of euphoria. When a trade feels easy and obvious, when everyone agrees, when the headlines confirm your position, that is precisely when you should be asking who is selling to all these buyers. Second, study volume, in context rather than isolation. A volume spike means nothing without understanding whether it represents accumulation or distribution. Look at what happens after the spike. Does price continue higher with ease, or does it struggle and fail? Third, recognize that being late to a move is expensive in ways that are not immediately obvious. The best gains in any trend go to those who entered early and quietly. By the time a move becomes obvious enough to attract widespread attention, much of the profit potential has already been captured, and the distribution phase may be beginning. Fourth, understand that your job as a retail trader is not to compete with institutions on their terms. It is to recognize the game being played and position yourself accordingly. Sometimes that means stepping aside entirely when the buying climax signals are present. The hardest part of this entire concept is emotional. It requires you to be most cautious precisely when you feel most confident. It asks you to question strength rather than celebrate it. It demands that you consider who benefits when you take a position. Most traders never develop this skepticism. They experience the buying climax as a series of frustrating losses, where they bought the top without understanding why. They blame bad luck or manipulation without recognizing the systematic pattern. Markets are not random. They are not fair. They are mechanisms for transferring wealth from those who react to those who anticipate. The buying climax is one of the most reliable wealth transfer events that occurs in financial markets. And it happens in plain sight, on charts that everyone can see, with volume that everyone can measure. The information is not hidden. The interpretation is what separates participants. Here is the question that should stay with you. The next time you see a stock surging on massive volume with universal bullish sentiment, the next time everything feels certain and obvious and right, ask yourself one thing. If everyone wants to buy, who exactly is doing all the selling? And what do they know that you do not?